China's markets are posting huge gains for this year. The Shenzhen Composite Index has more than doubled since January, if you weren't paying attention, making it the world's top performing stock market. The Hong Kong Exchange has gained 52% and the Shanghai is up 20% in the same period. With these gains comes a puzzle. While markets are red hot, China's growth was 7% last quarter. That is the lowest since the financial crisis. Jamie Metzl is senior fellow at the Atlantic Council. He joins me now to look at the disconnect between China's markets and the economy. Jamie, it's great to see you. So why are we seeing these markets on fire when you could argue, although 7% looks good compared to a lot of other parts of the world, we should say that, still it is slower than we've seen from China.
Well, the two stories are connected because China's economy is slowing, and that all of the numbers show that. But why are the stock markets taking off? And a few reasons. One is because there's an opening. They've connected the Shanghai and the Hong Kong stock markets, which has given Chinese investors an opportunity to invest outside of mainland China, and their money has been locked in domestically because of capital controls. So that creates a lot of opportunity. And then there's stimulus. The People's Bank of China has cut interest rates 3 times, and China has a state interest in moving the money that they have in debt to equity. And so they're pushing people into the stock markets. And the investors in the Chinese markets, unlike here, which are very sophisticated markets, 80% of the people who are investing are retail. They're mom and pop, a lot of illiterate people who are just throwing money into the stock market. And that's why you see these crazy valuations.
Okay, so when you say that gives one pause.
Ding, ding,
I mean,
ding,
you know, Greenspan said it nicely years ago when he called it a rational exuberance. Other people would say red-hot speculative mess. So should we be concerned?
We should be concerned because when you see a stock like China Railway, it's gone up 707% over the last year. A year ago, analysts were looking at this stock and they say, well, maybe it'll go at 15 or maybe 20%, but 700% rise is huge. And then in Hong Kong, we've seen these valuations going up and down by 50, 60, 70%. So it's really concerning. I mean, China has a lot of opportunity for growth because there's a lot of captive money that has to go somewhere. And it's logical that it could go into equity markets.
But not in a kind of gambling manner when it's not being done in an educated way, because you create a situation where people get burned, as we know from
It is gambling, and there's so much manipulation that happens in China. There's so many people who are triaging with insider information. So the little mom and pop guys, the guys who are putting their last RMB into the stock market because they've seen it go up and up and up, and they're afraid of missing out. And there are these rumors flying back and forth, so there will be pain, and sadly, the people on the bottom of the pyramid will likely feel it the most.
So can the government handle this, manage this situation, or are they also contributing into it? Because we saw some very weird action with Hanergy. The CEO has disappeared. Some people suggesting because he spoke out against the government. I mean, how do you see this playing out?
Well, it's a conflicting story because on one hand, the government is managing it. The government is really pushing people into the equity markets as a way of addressing, as I mentioned, China's big debt problem. And these interest rate cuts are all a way of growing the equity markets. At the same time, China realizes that if this bubble gets too big, there's going to be a crash, and it's going to fall back to them. So they're trying to do these two absolutely conflicting things simultaneously, and that's what's causing a lot of stress. But as you said, Maggie, when you see these kinds of valuations, it's not like the value of China Railway has gone up 700% over the last year. The valuations are out of whack, and eventually gravity applies.
Buyer beware is a lesson here, and for anyone sitting outside looking at the appeal, you're going to want to really do your homework, it sounds like, before you jump into that market. All right, Jamie, always great to catch up with you. Thank you so much.